The stock market is booming right now thanks to the devaluation of currencies worldwide. All central banks have decided to continue the policy of quantitative easing. On today's episode, we'll discuss the following: Japan's massive increase in QE to support the stock market, the Dow and the S&P hitting an all-time record high, and what to look out for during this QE environment. You came here for the truth, so let me unveil that for you. Let's look into what Japan has done and how that affects the globe. Beginning with this article right here, we're talking about the S&P, we're talking about the Dow Jones, and they're sending this message that they will continue to pump. U.S. stocks closed higher on Tuesday as fears eased over a Brexit, and Japan signaled more economic stimulus. Those are basically the 2 points. Those are the reasons why the stock market is up, supposedly. So you have the stock market up nearly 10% almost, if I'm not mistaken, and you're looking at this coming from such a low point after the Brexit situation. Nothing has changed yet. We're dealing with the same information from before. There has been no Brexit. There have been no increases in stimulus at this point. But just the talk of that has sent the market in a 10% swing. I think the things that people were worried about sort of faded into the background. No, they faded into the back of the newspaper. That's the way this works. Keep it out of the mainstream media and you keep it out of individuals' reality. And that includes the traders on the trading floor who are being replaced by automation. And let's move on to this. You have a lot of things conspiring to make this a very benign investing environment. What they want is for volatility to occur when you're in high frequency trading, and the average individuals just want to be able to put their money into sound investments, but that's getting harder and harder to do. The S&P 500 moved higher in record territory, and the Dow Jones Industrial Average closed at a new all-time high. We're talking right here about these milestones that are being reached, and this is all because of the devaluation of currencies. It's no hidden scheme. They show you publicly what they're doing for the most part. I think people are getting more comfortable within the growth area of the market. I definitely see more risk-on mentality. People are foregoing the yield plays for the growth parts of the market. Every single time you will see them go more and more risky up until the point where it's too late and they start shifting their money out. But of course, at that point, only the government can bail them out. Right here, this is actually 1 day old, but it's going to show you some information. U.S. stocks climbed to a record peak for the first time in more than a year on Monday, buoyed by expectations that the economy sits in a sweet spot, generating sufficient growth to drive earnings while keeping tighter Fed policy at bay. See, they desperately need to keep those interest rates down. And as long as they don't increase, the stock market may feel that it can continue, whether that's stagnating or whether that's increasing. If they even signal the fact that they will increase, stock markets will sink. This is a joke. Let's move on. Global equities are almost back to where they were before the EU, or I should say the Brexit vote. On prospects, policymakers will act to stem any fallout for the global economy. That means printing money. They will be there to backstop any issues, and that gives the market reassurance. The Bank of England is projected to cut its benchmark interest rates this week, while Japan, they said they will do so as well. They will print money. additional stimulus, whether it comes in the form of reduced interest rates, whether it comes in the form of QE, or whether that's a TARP bailout, they're all stimulus in one way, shape, or form to the economy. They are needed, in fact. At this point, I don't even disagree with their policies because they've already gone so far. The only way out of this is directly into the ground. That's what I think they should do at this point, because I mean, I've thought about it many hours here, and this is something consistent, where can they possibly dig themselves out of this mess? And as far as I'm concerned, it's not possible. So I say just ramp up the printing presses and let's get this over with. Just print the dollars right into the ground, destroy it completely, enter some high level of inflation as they do this, and then we rebuild. This is the best way to just get it over with as soon as possible. The fact that the sooner it's done, the quicker that it will be able to be restored. But of course, it's generally not the way they do that. Look at this here. Stimulus play. Bets able boost fiscal support is dominating Japanese trading. Of course, this is how it all goes. You see the markets acting erratically before any Federal Reserve meeting, whether they think it's going to happen, whether they'll increase interest rates or decrease them or introduce quantitative easing and this and that. So look at this right here as you see the stock market moving erratically on Japan's decision to increase or not to increase. Then we switch pages a little bit to see Amazon doing extremely well, Jeff Bezos doing extremely well. And this goes to show you that certain companies are doing very well. But the global economy, the global stock market, isn't doing very well. But you pick apart these select stocks and use that to your advantage, and you can show how things are just fine. But I believe in looking at it at a deeper level, and you do see the correlation right here in between how much the central bank prints and that stock market of that particular country. Hang on to that for a moment here. Federal Reserve Bank total assets. This is from the St. Louis Fed. I've shown this many times. It's the balance sheet of the Federal Reserve. Keep your eyes on this. In fact, what you can do is head over to a search engine and type in, let's say, Japan balance sheet, and you can get the similar chart like this of that particular country's balance sheet, and you can follow it and then sort of match that up with what's happening with that particular stock market. Very interesting to see that correlation. This here is just what I wanted to leave with. We're looking at Obamacare. Obamacare was responsible for one quarter showing a 5% GDP increase. Amazing. They did so well that month or that quarter. Unfortunately, it was because people were taxed heavily for the introduction of Obamacare. Now, what we have with Obamacare isn't necessarily better care. In fact, if you look at this, the Affordable Care Act, there's an increase in the amount of community health workers. So people don't necessarily get to see a doctor for their issues. They speak to community health workers. I would just say that the amount of care that you get doesn't necessarily come from so-called free healthcare. Just by having it being supported by the government doesn't necessarily mean the care will be any better. Look at what's happening. It's just getting worse. That's it for today. If you found this video informative, please give me a thumbs up. And last but not least, if you found the video informative, I know you'll find my book, The Money GPS, even more informative. If you want to look through the book, head over to Amazon. They have a look inside feature which will allow you to flip through the pages of the book and see if you like it. Take care.